Cash. It sounds boring, but in Warren Buffett's hands, it's anything but. His cash pile just keeps smashing records. And the big question is, why? What does that mean for the market, for the economy, and most importantly, for regular investors like us? Here's a crazy way to look at it. If Buffett's cash reserves were their own company, they'd rank as the 27th largest in the world. Think about that for a second. His cash alone would outrank the market caps of legendary European companies like BMW, Adidas, Heineken, ING, and even Airbus combined. And that's not just a fun financial fact, that's Buffett sending the world a very clear message. He doesn't see enough good opportunities out there right now, and when Buffett sits on his hands, we should probably pay attention. So what can we as investors learn from this, and how should we interpret it? To get there, we first need to look at one of Buffett's favorite tools, the so-called Buffett Indicator. So this indicator basically takes the total market value of all U.S. publicly traded companies measured by the Wilshire 5000 index and compares it to U.S. GDP. Historically, Buffett has said it's honestly one of the best yardsticks for understanding whether the market is overvalued or undervalued. And here's the eye-opener. In 2025, this indicator crossed the 200% level for the very first time. To put that in perspective, the long-term average is closer to 125%. That means the U.S. stock market, by this measure, is trading more than 50% above its normal fair value. The last time this ratio spiked so high, we were staring down the dot-com bubble. And yeah, we all know how that ended. Back in 2008, the indicator told a very different story. After the crash, valuations dipped well below average, signaling a rare moment when stocks were actually cheap. That's when Buffett pounced, scooping up bargains while others were running for cover. Fast forward to today and you'll see that Buffett's Berkshire Hathaway is holding nearly $350 billion in cash, a record-breaking mountain of dry powder. And you know, it's not sitting there by accident. This is the result of decades of discipline, some really careful calculations, and that legendary Buffett patience. So, why so much cash now? Well, it's because Buffett doesn't see deals that meet his standards. Remember, during the last financial crisis, his cash levels were also extremely high. And when the storm finally hit, he had the flexibility to step in. He famously injected billions into Goldman Sachs and General Electric at the depths of the panic, striking deals that, honestly, ordinary investors could only dream of. And here's the kicker. Buffett doesn't try to predict crashes. He said it over and over. He doesn't care if the market tanks tomorrow or rockets higher next week. His philosophy is much simpler. Buy great companies at fair prices. When the prices aren't right, he waits. That mountain of cash isn't fear, it's discipline. But holding this much cash comes with its own challenges. Berkshire is so massive now that Buffett has fewer options. He doesn't want to own more than 10% of most public companies because of regulations. And at this size, he can't just buy small or mid-sized businesses. He needs giant, high-quality targets. As Charlie Munger once put it, their size has become both a blessing and a curse. Still, even sitting on cash makes Buffett money. Berkshire earns about $12 billion a year just from short-term U.S. Treasury bills. That's right. Buffett actually owns more short-term treasuries than the Federal Reserve itself. And since treasuries are considered nearly as safe as cash, but currently yield around 4%, it's a no-brainer place for him to park money while waiting for real opportunities. It's also worth remembering that Berkshire isn't just an investment vehicle, it's actually the largest insurance company in the world. Through subsidiaries like Geico and General Ray, it collects billions in insurance premiums every year. These premiums, known as float, aren't really Berkshire's money, but Buffett gets to invest them until claims need to be paid. And that's why a huge cash cushion isn't just smart, it's essential. Insurance companies need massive reserves to survive unexpected disasters. History proves the point. Think about 9/11, think about Hurricane Katrina, think about the 2008 meltdown or even the COVID-19 pandemic. Every 20 or 30 years, something happens that knocks the insurance industry off balance. Buffett has always said, we can't afford to be the company that isn't prepared. His number one rule is simple. Don't lose money. And his number two rule? Don't forget rule number one. So what does all this mean for us as investors? First, don't mistake Buffett's cash pile for panic. He's not calling the top of the market. He's simply saying, I don't see value right now. That's a big difference. Second, cash is a tool, not a burden. It gives you flexibility, security, and the ability to act when opportunity strikes. Buffett may have 30% of his assets in cash today, but he's still 70% invested in the market. That balance is key. Third, and maybe most importantly, we need to learn patience. In investing, sometimes the hardest move is no move. Buffett himself jokes that one of the best investing skills is being able to, watch paint dry. It's about resisting the urge to chase every rally or jump on every hot stock. Instead, it's about waiting for the pitch you can hit out of the park. And when panic does hit, patience pays off. In 2008, Buffett was ready. During COVID, he was calm while others were panicking. His discipline allowed him not just to survive but to thrive. That's a lesson all of us can take to heart. Now, markets today are different from decades past. Technology stocks are pushing indexes to record highs. Algorithms trade millions of times per second. FOMO drives people into risky bets. And yet there's Buffett, sitting quietly with $350 billion waiting for the right moment. That's not weakness, that's power. So, what can we do with this insight? We can stop thinking of cash as dead money. Instead, we can view it as optionality, the ability to act decisively when others can't. We can balance our portfolios, stay invested but keep some dry powder for when true bargains appear. And above all, we can remember that in the investing game, patience is not wasted time, it's a strategy. If you made it this far, you're serious about learning from Buffett's playbook. And if you want to keep following along with smart investing insights like this, make sure to subscribe to MoneyQuest Broker. That way, you won't miss any of the upcoming deep dives into strategies, ETFs, and the habits of world-class investors. And one last note. This isn't financial advice, it's for educational purposes only. Always do your own research or talk to a licensed financial advisor before making investment decisions.